Let's welcome Satyajit, whose book Extreme Money, Masters of the Universe and the Cult of Risk, which is about to be published. Das, thanks very much indeed for joining us. Well, I called people who are talking about contagion in the Eurozone as doomsayers, and you're saying, well, you're in the majority now.
I think that's right. I think it's right. You've got to look at it in three little bits. One is the Greeks have passed some austerity measures and put some implementation bills. Everybody knows, no matter what they do, they can't actually reduce the budget deficit and get their debt under control. I mean, they're going to miss every target. That's number one. Number two, the European Union, with its French plan, basically can't get its act into gear to work out what they want the private sector to do. And so basically that's failing. And then ultimately the question is, we're seeing yields on Portugal, Ireland, Spain and Italy rise. So contagion is a reality. And you have the ECB basically funding a whole swathe of European banks. So where's the good news?
Well, and the next shoe to drop is Portugal and Moody's downgrading, of course, in the last 48 hours, that country's debt to junk. Now, there's been a furious reaction from the European Commission president here as well. Do you think that they were overreacting, or according to at least one commentator today saying, well, they called a spade, Moody's?
Oh, I absolutely agree. I mean, how can a country which is basically completely reliant on bailouts, this is both Ireland, Portugal and Greece, essentially their banking system is dependent on official funding from the European Central Bank because they have lost all commercial access to funding, be investment grade? I mean, that's just ridiculous. And I think everybody in the market knew they weren't basically investment grade. So what Moodys is doing is confirming the inevitable. But the major thing which is really hilarious about all of this is the umbrage coming from the European Union. But the most interesting thing here is it's got very little to do with what they're saying. The real issue here somebody should look at is the European Central Bank has exposure just to Greece of, according to the Dutch Finance Ministry, of 130 to 140 billion. If Greece goes, what's the credit standing of the European Central Bank? Because it's only got 5 billion in capital going to 10. So I think there should be some interesting questions about the ECB and other instrumentalities of the European Union. That's the real issue, and I'd like Moody's to have a look at that.
Well, what about defaults here? I mean, surely that's what you're saying is it's inevitable that they're going to be defaulting, so they should do that sooner rather than later. But there's no mechanism then with a default with what could lead to them actually having to leave the currency union as a consequence.
Well, I think there are two issues here. One is how do you default? And I agree with you. There are quite considerable degrees of difficulty in how you structure the arrangements. But I think the fact of the matter is you have to reduce the debt burden of the peripheral economies. And we can argue about whether it should be 30%, 50%, 70%, but it's in that order of magnitude. So that has to be done. Then there's a second and a quite separate issue. And that separate issue is about competitiveness of the economy. We all know how we get out of a debt problem. It's growth. We have to grow the economy. And for Greece, Ireland, is a lesser extent, but certainly Portugal and Spain, getting out of the euro and being able to devalue their currency would obviously give them some chance, together with some debt restructuring, to grow the economy and so to minimize the losses. And I think they're two separate issues. I think they have to be dealt with probably about the same time, but there's two separate issues, and there's confusion between that. I mean, the European Union, which is like a three-ring circus at the moment, basically confused the survival of the whole Eurozone, of the European Union and free trade with Greece. That's not the issue. Greece has a debt problem and a competitiveness problem, and so does Spain, and so does Portugal, and to a lesser extent so does Ireland. They have to be dealt with.
Let's talk about China and its banks, because they have a whole set of different problems. Would you like to outline them?
Well, I think the first problem is most people think the Chinese economy recovered miraculously after the events of 2008, when you'll recall that the economy shrank. It didn't. What the Chinese state did was pump a lot of money into the system. The good old Botox of money came out. And basically there were two or three ways they did it. One was the government itself, but the major source was the banks expanded lending across the board to state-owned enterprises, but particularly to municipal and local governments. Now, they basically almost doubled their loan books in 2009 and did something similar in 2010. Now, somebody once asked me, what does that mean? I said, well, if you double your loan book, generally it means there's bad debts down the track somewhere because you can't actually expand at that rate and make good loans. And that's pretty much what has happened. And fundamentally, we've seen in the last probably a month or so, a lot of statistics come out. By the way, none of them are the same. The range of the debt, for instance, for the municipal area is somewhere between $1 trillion and $2.2 trillion US dollars equivalent. But this debt is problematic. And we know that a lot of this won't get paid back. And the Chinese regulators themselves are saying about 25% of these so-called infrastructure loans is going to go bad. Now, the question is how that's going to be dealt with. Now, people have very short memories. The Chinese banking sector has a history of NPL problems. But generally what happens is the government takes these off the bank's books, sticks them in a special vehicle called Divine Wind or something like that, puts a government guarantee on that, sells the bonds back to the bank. And that's what they've done.
What you're saying here is you've got a big moral hazard issue.
Oh, absolutely. It's a huge moral hazard issue, but to some extent the moral hazard in China is confusing because it's a state-owned bank lending to a state-owned enterprise or an arm of government. So it's shuffling money between different pockets. Now the question is, can the Chinese state afford, certainly the moral hazard, but also afford to pay for all of this? And that's an unknown. And I don't buy this huge idea that their $3 trillion of reserve makes them immune from everything, because that $3 trillion rather is not monetizable, because they're in US dollars, euros, and yen, and they can't sell it. So the question is, at what point does the Chinese state get itself into a problem in terms of recapitalizing the bank and taking this stuff off the balance sheet? We haven't reached that point yet. But it will come, and it will come at some stage in the next few years.
Will this lead to the economic story coming to a grinding halt there in China?
Oh, I don't think it's coming to a grinding halt. I think it's two problems. One is a short-term problem. Essentially, the Chinese central bank and the government have been alarmed at inflation and the rate of bank lending. They're trying to wind that back. And that's been going on for a better part of 12 months. And that's obviously going to slow down activity. But there's two other factors which are much more important. One is Europe is China's largest trading partner. And these European debt woes will have some impact on trade. The second element is a much longer-term story. China's growth has been driven by investment. And that investment is increasingly marginal and low returning. And we saw this in Japan through the 80s and particularly the 90s. And what has happened there is probably a window into what could happen in China, which is as this investment basically becomes unproductive or low productive, because they're basically investing in things which are not going to give reasonable rates of return, like superfast trains and so forth, then the growth will come down. So I think you've got to look at it as a very short-term and a longer-term issue. And they've got different dynamics, but the picture is very clear. No country can grow at 8% forever.
Satyajit does. Thank you so much for joining us.